I'm very excited to be joined by investment guru, market pundit, legendary podcaster, the blogger, author of the new book, How Not to Invest, and founder of Ritholtz Wealth Management, Barry Ritholtz. I'm never totally sure about people who name their businesses after themselves, but Barry, welcome to Mehlman Consulting's book author series. Great to have you.
Thank you so much for having me. The funny thing is the name was a placeholder. It was never supposed to be permanent. After the financial crisis, I was really well known and we just never found a better name, so we're kind of stuck with it.
I
I
was
would love
always
to take my name off the door after I've seen trouble various people have gotten into whose names are on the door for untoward tweets or just, ABC Corp is a far less problematic name when the founder who just was someone just got a DWI, their name is on the door. Someone else was just accused of running naked through a party, like just dumb stuff that you don't have to think twice about if it's ABC company.
I'm sorry that your firm name means you can't run naked through a party, but on behalf of the party goers, keep your name of your firm the way it is.
All
So
right.
I love the book. I'll be honest, you sent it to me. I got intimidated at first by the size, but it flies. It's a
It's
really, it's a doorstop, but at the same time, you can read if you want to read 5 minutes a night. It's the most readable 450 pages I can remember. Let's start with a title though. Because
sure.
how not to invest, some might say, is how not to title a book. And yet there's actually a logic to it that I liked a lot. Explain when you came up with the title and why you came up with the title.
So Bailout Nation came out in the fall of 2009, and ever since then I've had publishers, hey, let's do another book. And writing a book is time consuming and exhausting, and I'm building a business. I don't have time to write a book. And our friend Morgan Housel, right around the pandemic, started twisting my arm and saying, "No, no, you don't understand. You have so much material you've written. You've done quarterly calls. You've done all these research notes and commentaries and white papers. You just stitch them together. It's really easy." That was a white lie, and it turns out I don't know, about three-quarters of this is new. The prior writings gave me a framework because I have in my office this giant bulletin board, and I started putting on the board. I have a big stack of 3x5 cards and just chapter ideas one after another. And normally I work digitally, but this gave me an opportunity to kind of move stuff around. And I don't want to say it's self organized, but what ended up happening was, gee, there were three really broad sections of prior research and writing. Hey, here's a whole bunch of bad ideas that they're zombie ideas. They never die, even though they consistently are debunked all the time. Um, and then the maths. Here's a bunch of numbers and mathematical concepts that people either don't understand or consistently get wrong. And then all of that manifests in bad behavior. And we see these behaviors over and over again. Doesn't matter if you're a newbie investor, if you're a billionaire, anything in between. People are people. Humans have the same wetware. And we make the same mistakes over and over again. So after the pandemic, Morgan had published The Psychology of Money.
Great book.
And I said to him, do we really need another book telling people what to do? Over the past 100 years, I don't know, what have been 20,000 books on how to invest, and people are still pretty mediocre investors. So he goes, how do you fix that? So, well, maybe the thing to do is, instead of telling them what to do, maybe if they made fewer mistakes, had less bad ideas, less bad math, and understood, the risks. Maybe then, if they did fewer, if they instead of telling them what to do, we told them what not to do. Maybe that might help people. And he goes, "All right, do that." And so I spoke to the publisher, and the first thing they said is, you should never use "not" in a title. That's a terrible mistake. And I said, well, no one's done it before. By the way, there are a dozen books on how to invest, how to buy stocks, how to buy mutual funds, how to buy alts, how to trade options, how to. And everybody's still not that great. So, hey, I'm a big fan of Charlie Munger and a big fan of Charlie Ellis. Charlie Ellis was the legendary founder of Greenwich Associates, chairman of the Yale Endowment, on the board of directors of Vanguard. And Charlie Ellis described investing as a loser's game. What's a loser's game? Well, tennis is two types of games in one: a winner's game and a loser's game. The professional tennis players play a winner's game. They hit with power, they hit with accuracy, they score aces on serves, they keep the ball away from their opponent. They win by scoring points. Everybody else, guys like you and me who are amateurs, the other 99.9% of tennis players, that's not how we win. We lose through mistakes, through unforced errors. We double fault on the serve, we hit the ball long, we hit it wide, we hit it into the net, we don't put enough spin on it, we hit it right to our opponent's sweet spot. And that's how we lose as tennis players. We effectively beat ourselves. And Ellis, in the book Winning the Loser's Game, explained investing is the same thing. If we made fewer mistakes, we'd all be so much better off.
Well, it's uncanny how you've done so much Oppo research on the history of my tennis playing, but you nailed me. All right, so there are there are so many important points and important ideas, and this is a 45-minute conversation, so we're not going to get to them all. Pick your three favorite. What are the three mistakes that, if we avoid, move the needle the most?
So there's a couple of obvious ones. And I'm some of the other ones are more interesting, but I'm going to give you the three biggest ones. First, we believe we can pick stocks. And all the data, all the academic research, Dalbar, Morningstar, you name it, CRISP, whatever academic research has come out, has made it pretty clear that people aren't great stock pickers. And when we look at the data for professional fund managers, in any given year, less than half beat their benchmark, whether it's the S&P 500 or the Wilshire 500. It's a 50% fail rate. That's over 1 year. Expand that to 5 years, and it's 80% fail to beat their benchmark. 10 years, I'm sorry, 10 years is 80%. No, that's right. 5 years is 80%. 10 years is 90%. And then you expand it to 20 years, and a handful of outliers whose names we know beat the benchmark. It's Peter Lynch, it's Warren Buffett, it's Will Danhoff, it's a handful of people. So with those odds stacked against us, why would anyone want to pick stocks? And yet we all love picking stocks. It's an addiction. We want that serotonin dopamine rush by picking a winner and then riding it. So that's the first error. The second error is we imagine that the news we're watching is going to help us invest and trade. And we imagine that we will be able to jump in and out of markets, get out of the way before it gets bad, get back in before it runs up. And again, the academic data is we're terrible at that. How bad are we at that? Well, depending on which research you use, there's some from JP Morgan, some from Dalbar. The most recent research comes from Morningstar, Jeff Patak, and they find that the average investor underperforms their own investments by 50 to 100 basis points. How do you underperform your own investments? Well, it turns out that if a mutual fund runs up and you buy it, and then it kind of returns back to where it was, and then it moves forward, you paid more than the average investor. Or conversely, the mutual fund starts to roll over, people panic sell, and then it bounces right back and they jump back in. And so they're leaving all this money on the table. The granddaddy of underperforming your own investments are investors in Cathie Wood's ARK. ARKK is the ETF. By the way, she did nothing wrong. She runs a high, a low, a high active share, a low closet index sort of fund. It's very concentrated. It's very high beta, a lot of volatility. But 93% of her investors are underwater, meaning 2021, it ran all the way up. That's when people bought it. It then proceeded to crash 75, 80%. And now it's doing pretty well again. I want to say it's about even with the S&P 500 since inception in 2014, but it's a crazy ride up and a crazy ride down. So that's the second thing we do is We think we can time the market. It turns out we can't. And the reason we can't is by the time you're seeing it on CNBC or Bloomberg or reading it in the Wall Street Journal, whatever you're seeing is already reflected in stock price. So it's too late. If you genuinely understand something the market doesn't know yet, well, maybe you have a chance of generating alpha that way. But if it's in the paper, if it's on TV, it's already in the price. So jumping in and out isn't going to help you. And then the last thing we do is listen, people are emotional creatures. It's been a useful part of our evolutionary history. The fight or flight response, when either enthusiastic or threatened, has helped us stay alive. Unlike other creatures, we have neither fangs nor claws nor armor, so we are very vulnerable. And by being a cooperative primate that's clever and can use tools and can, set up a group dynamic, we've survived and thrived in pretty much every environmental niche on the planet. And part of that is our emotional reactions to keep us safe from threats. Now, seeing a potentially poisonous viper in the tall grass, or a jaguar in the trees, that's a very different setup than, gee, what's going on with my muni bond portfolio? Why are my bonds falling when the Fed is cutting rates? What does this mean for us? Like, we didn't evolve to make those sort of risk reward decisions. We evolved to get out of the way when something dangerous was coming. And that wiring is built into us. And so the market drops 10% and we feel threatened. I mean, the market didn't get killed in April post Liberation Day. It fell about 15%. Like, it's not like a horrible crash. And yet that 15% drop made a lot of people panicked. And then, 8 days later, we were off to the races. So your emotional response to what's going on typically will help you survive on the savannah, not so much on Wall Street.
So to that point, one of the things, at least I've read, probably you highlighted it for me because I love you're such a good aggregator, but a lot of observers seem to believe we've seen a divergence between the professionals and the retail investors. And the retail investors keep thinking they're going to buy the dip. Is that reflective in your mind of a just larger herd of emotionally driven, not following logic or fundamentals, folks acting irrationally? And even if that's the case, if you're a professional, can you ignore it? Because I forget who said the market can be irrational longer than you can stay solvent.
Right. Often incorrectly attributed to John Maynard Keynes. We have yet to find evidence that he actually wrote or said that. So here's the interesting thing. We look at a trading vehicle like SPY, the S&P 500 State Street ETF. It's the biggest ETF, or at least it used to be. I don't know if GLD passed it, but it used to be the biggest ETF in the world. And it's mostly thought of as a trading vehicle used by professionals. When we look at some of the other ETFs, VTI, the Vanguard Total Market, that's similar, or I forgot the symbol for the BlackRock one. What we've noticed, and every time there's a downturn, so it could be 2022, it could be the first quarter of 2020, it could be Q4 2018. We see SPY having outflows and getting sold off by the professionals. But during a down move in those environments, we see Vanguard and BlackRock being bought. And what seems to have happened is, the market used to call mom and pop Main Street investors the dumb money. But since the financial crisis, it appears that the dumb money, in quotes, is outperforming the smart money. And the dip buyers, the mom and pop investors who have a 20-year time horizon, they're not worrying about quarterly reports to their clients, and they're certainly not worried about clients calling every 5 or 10% dip. They're able to take advantage of when markets go on sale. The professionals, they're deeply concerned about where they want to, what their quarterly bonus is going to look like. And if they smell a little bit of trouble, they head for the exits. As it turns out, that hasn't worked for them. It didn't work in Q1 2020. It didn't work in Liberation Day. I guess if you sidestep 2022 and your timing was perfect, maybe you could have avoided that 19% downdraft before 23 was plus 25 and 24 was plus 25. But what we actually saw happen is the pros sold and Main Street bought.
All right. Well, that actually that's interesting because on that take, rather than thinking the dumb money is dumb, you're suggesting the money freed from being second guessed by clients who aren't worried. And that makes me wonder about I think just this week, I mean, there's so much crazy news out of Washington always, but I thought just this week the president said that quarterly reporting by businesses causes he didn't use this phrase, but basically short-termitis when it comes to management. And he thinks twice a year would be more appropriate, which is kind of weirdly unrelated to all of the culture war kind of chaos. For that same reason, would you think that's a superior approach to corporate reporting instead of quarterly going twice a year?
No, that's even worse, and I'll explain why.
Great.
So about 15 years ago, I worked in a shop that did quarterly reporting. Right, it was a institutional shop. All the clients were institutional, and technology has evolved a lot in the ensuing decade and a half. But back then, each quarter we would have to wait till the last day of the quarter and then print out every client's account, every statement with a cover letter and a sticky address, and it would all get put in a big manila envelope, and you had to make sure right statement, right cover letter, right address. And it was a big deal, and we would host a conference call, and we'd get phone calls, and it was a giant thing. 5 years later, I launched my own firm, and we start using technology to allow people to check their balance statement. Not only it started out daily, but eventually it became tick by tick. You could look at your value anytime you want, night, day, see it move literally like this throughout the day. And once we made the big quarterly number go away, people cared less about it. And the question became what's the trend like? Am I on track to hit my target? Am I going to be able to retire when I want to retire? That becomes the issue. Not, are we beating the market by 50 basis points? Are we lagging the market by 50? Like the performance numbers were focused on a goal instead of what have I done over the past 90 days. So I think if we were to make company reporting twice a year, hey, you've just made it twice as significant as 4 times a year. Think about what happens to the company that misses the semi-annual reporting. They're going to get shellacked. They're really going to get taken out to the wood shop. If you think about what technology can do, the combination of software and AI, I don't think it's that far off in the future where, with some guidance and regulation by the SEC, companies couldn't report in real time. Hey, here's what we're seeing day by day. Here, we're above trend, we're below trend, we're on target for the guidance we gave you. Here's where we're seeing the economy soften up. Here's where we're seeing the economy get better. And once you move away from quarterly profits and the big insider benefits from a good number, remember, most of the C-suite executives are compensated through stock options. So they have every incentive to do buybacks, even if buybacks may not be indicated. They have every incentive to manage towards the quarterly number. I think the solution to 4 times a year isn't to make it twice as significant twice a year. It's to do it monthly and then weekly and then daily. And the technology exists for that. By the way, that was a column I wrote for Bloomberg back in 2018, before AI was even a thing. The capabilities today are just so much better than they were 5, 10 years ago. I don't think anyone with a straight face can tell me, no, the technology doesn't exist in 10 years for companies to update their shareholders on a monthly, weekly, or even daily basis. And so the big focus on the quarterlies goes away.
Although it's interesting, I know a bunch of CEOs who have done either take privates or who are private and decided not to go public precisely because they felt like the desire to manage for the long term is best accomplished without whether it's quarterly. And if you went to them and you said real time, they'd be like, that's crazy. We want to make long bets, and the investing market public doesn't have a patience or necessarily an understanding. I mean, some people, I guess Amazon, Bezos, everybody got what he was doing, or at least accepted what he was doing. And so until AWS forced him to be profitable, he managed to avoid it. Let me ask you, Barry, I've got a bunch of market questions, and as it sort of relates to a lot of the public policy. And if we ultimately had time, which we probably won't, I may ask people to throw cues in the chat because it's fun. But what exactly is Ritholtz Wealth Management? Because when I got to know you guys, you're just this great content aggregator. You host authors like Morgan Housel. I love your daily 10 Subway reads. Are you a publisher? Are you a pundit? Are you a money manager? I can't. It seems like you're everything. What do you think of Ritholtz Wealth Management is?
So the short answer is yes to all those questions. The longer answer is I've been writing about markets and the economy from a somewhat skewed perspective for, almost 30 years. Certainly started on GeoCities in the late 90s because I was frustrated with the quality and breadth of media coverage of markets. It was filled with errors, filled with cognitive mistakes, filled with statistical errors. I remember getting into an argument with the editors at the Wall Street Journal in '06 who were talking about the improving housing market from March to April to May. And I'm like, guys, that's seasonal. It always improves from March to April to May. You look at it year over year, '06 is worse than '05, '05 was worse than '04. Year over year with no seasonal effects, it's going down. You have to understand what seasonal adjustments are. So the writing began just out of frustration with a lot of bad ideas out there. Having gotten more or less the financial crisis right at the top and at the bottom, people started throwing money at us. And so I said, all right, let's, I got tired of turning people away and then hearing they went to some sort of overpriced shop that I wasn't a fan of. And so we launched our own firm in, call it the fall of 2013. That was about 12 years ago and about $7 billion ago. So what we do is we use a lot of technology. We're very forward leaning into what's going on. We're big fans of direct indexing for both stocks and bonds. Tax loss harvesting is a really big factor. The basic investment strategy is pretty plain vanilla. It's pretty boring. Own a broad assortment of diverse equities through mutual funds and ETFs, preferably low cost. Have the core of that be fairly index based. Hey, if you want to decorate it with, put some more ornaments on the tree, all right, here's a momentum sleeve and here's a micro cap sleeve and here's a global value sleeve. And so you could dance around that core, but you can't get alpha if you don't at least start with beta. And so that's what we do. We have no minimum. We have a couple of digital platforms they're not robo advisors because they come with a live human certified financial planner, but you can charge a whole lot less if you're not using people to do the account opening, the digital onboarding, all that stuff. So we keep it pretty reasonably priced for that. And we've been doing this for a dozen years and no end in sight.
Why so much of on the free content, the Morgan Housels, the Batnicks, which I love, but do you find it helps with visibility, helps folks find you, or are do you have is it sort of the backing into Benioff bought Time magazine after he was a billionaire? You're kind of building both at the same time.
um so it started just out of frustration. I mean, I started blogging in '98, moved from GeoCities to Typepad in '03, and then from Typepad to WordPress in '08. I'm still on WordPress. Some of my colleagues are on Beehive or Stack or Substack. And it just was a way to our business model is so weird. hey, you could do this with yourself if you manage your emotions, have a broadly diversified portfolio of low cost indexes. And if some of you want some help, we're happy to charge you a fee to do that. I'm as surprised as anybody that 4,000 families came along and said, yes, we would like you to do this. We don't have the time nor the discipline to do it ourselves. And so that's someone says, Wiki says 5 billion. Our June 30th Form ADV was 6.4, and just extrapolate forward from the market gain since then. And that's how you get over 7. Well, I think we do the next Form ADV update at the end of the year. But, the whole idea behind the content wasn't let's put out a whole bunch of content for free for 15 years and then we'll open a firm and people will throw money at us. It just kind of was who I was and what we are, and everybody around me has the same belief system. And so there's a kind of a myth. Hey, I did this. I heard this podcast. I read this blog post. I'm going to give that guy $5 million. Doesn't work that way. But what it does do is when you start speaking with somebody who's looking for an advisor and looking for a financial plan, they know who you are. They understand your philosophy. What's normally a 6-month dance becomes much shorter because you're not starting from square one. They're like, all right, I know who these guys are. I know what they stand for. That works for me. And so it just gives everybody an easier way to look at this.
Yeah, I think the other benefit, and somebody in your world has written this too, um, it helps you understand what you believe and what you think. I
Right.
so often have a take in my head that makes great sense when I'm driving to work or walking the dog. And then I try to write it, and no good idea in my head survives first contact with the screen, with a piece of paper, with the screen. And then I got to redo the whole thing because it didn't work, and I wrote it. And then for me, at least, once I've written it, all right, now go present it, and it's like, all right, well, that was crap too. It's and it forces you to get to something where once you can articulate it in a way that others understand it, and it can survive the give and take. I just find it. I understand my own thinking so much better, and the ideas are so much sharper.
That's the great quote from Daniel Boorstin. I write to figure out what I think, and besides, at that hour, none of the bars are open. Is his very famous line. Former Librarian of Congress.
Brilliant. All right. Back to the world that's going on right now. You think the Fed got it right yesterday? I'm interested in your take on inflation versus recession versus stagflation. The economy right now, too hot, too cold, just right. What's your read?
So the one thing to understand about the Federal Reserve is they're a big conservative institution, and they are always late to the party. So just not even talking about yesterday, just generally. They were late to recognize inflation in 21, 22. They were late to start raising rates. They were late to notice that inflation had peaked in June 2022, and they were late to start cutting. That's what large August conservative institutions tend to do. I thought Jerome Powell made a fairly compelling case. On the one hand, there are signs that inflation is ticking up, especially when we work in some of the effects of the tariffs. But the bigger risk is to the downside because not only have we seen employment soften and the labor force become a little weaker, but we had that giant adjustment, and it turns out the economy was less hot over the past 24 months than we thought. So he sees the downside risk as bigger than the upside risk. Let's be honest, the quarter point isn't going to ignite inflation. The interesting way to think about this is from early 2000s to, let's call it 2022, that was an era of monetary stimulus. We had zero interest rate. We had low inflation. 2% was the upside target. Starting in early 2020 during the pandemic, we shifted from monetary stimulus to the era of fiscal stimulus. The CARES Act 1 under President Trump was the largest single fiscal stimulus as a percentage of GDP since World War II. The CARES Act 2 just threw another $700-800 billion on top of it. And then Biden comes in with CARES Act 3, another $1 trillion. So you combine the fiscal stimulus of Trump with the fiscal stimulus of Biden, and you end up with a lot of inflation. But folks like Ed Yardini has pointed out every time you have an inflation spike, it tends to be symmetrical. The faster it goes up, the faster it goes down. It means hot money is driving it. And when hot money cools off, it comes down. And that's why that was transitory rather than structural. Think back to the 70s where you had all sorts of structural inputs to higher prices. I would tell you the structural part of inflation now has been the cost of college and medical care, but that's been, high single, low double digits for the past 30 years. And the economy seems to have shrugged it off. So the fiscal stimulus caused this giant spike in inflation. It came back down. I don't have a problem with 25 basis points cut now. I don't have a problem with another one later this year and maybe a couple next year. The challenge, I think, is that countries that don't have an independent central bank have run into problems, have run into inflationary problems. There's a reason Congress set up the Fed as a separate independent entity. I'm not keen about having any president to control the Fed. And as we've seen historically, when the president is barking at the Fed, it has not worked out well for markets over the long haul. Usually, that's a correlation error. Usually, if the president's yelling at the Fed, it's because inflation is hot and the economy is slowing down. And that's we're not quite in full stagflation. We're sort of in demi-stagflation. We have a little bit of stag and a little bit of inflation, and hopefully both of those things ease up on their own.
All right. Well, so another downstream effect of all the fiscal stimulus you just described is the national debt keeps rising. We're basically, as a share of GDP, which at one point you took me to task because I put out a chart with just the raw number, and you correctly pointed out what matters also is the size of the economy. But as a share of GDP now, our national debt is as if we were just fighting World War II, which was a pretty big thing.
Mm-hmm.
And looking forward, we're looking at annual $2 trillion debt where interest payments are going to be more than our defense spend. For investors, not a problem. We're going bankrupt gradually, then suddenly. What's your take on what your average investor ought to think about a nation as in debt, and frankly, a world that is, because it's true in a lot of other places too, Japan, China. How should regular investors think about sovereign debt?
So I've been hearing that the deficit and the ongoing debt is going to be really problematic since I was in high school in the 1970s. And the warning was it'll crowd out private capital. No one will lend to Uncle Sam except at really high rates. It'll cause inflation to skyrocket, and it'll just be the end of innovation. And that's 50 years ago, and none of those things have come true. Uncle Sam could borrow at 3.5%, 4%. There's endless amounts of capital sloshing through the system. When we look at the ratio of debt to GDP at a place like Japan, it's over 200 and something percent. We're barely over 100%. So if Japan is the frame of reference, hey, we're only halfway there. At one point in the future, the debt will become a problem. I just have no idea where that point is, but I can tell you it's been a solid 50 years of people warning about it, and none of their warnings have come to pass. So maybe we need a new theory on debt. I don't know when it's a problem, but it hasn't really been a problem over 50 years. And the reason you could tell that is the party out of power always complains about the deficit spending. And then as soon as they get back into power, they start deficit spending. Doesn't matter, Republican, Democrat. The last time we had a balanced budget was, I think, 98 under Clinton. And nobody really cared. The market didn't care. The voters didn't care. It really wasn't significant. So I'm assuming at some point it will matter. I just have no idea where that point is. And, maybe it's today, maybe it's 2075. I have no idea.
All right, let's keep going with things that you probably don't know, but I'm going to ask you about anyway. So go to crypto.
Mm-hmm.
Warren Buffett, who of course has had many great choice quotes, in 2018, besides I think referring to it as rat poison, he said, "quote I can say almost certainty that they will come to a bad ending, meaning crypto. If I could buy 5-year put on every one of the cryptocurrencies, I'd be glad to do it." Markets haven't agreed with him so far. The aggregate's north of $4 trillion. What's your take on cryptocurrencies?
So there are two ways to think of crypto. The simple way to think of it is crypto is a tech company somewhere between Microsoft and Google. Like it slots right in there, right? That's what Bitcoin is or Ethereum is. But there's another way to think about it because every time I ask people who are big crypto enthusiasts, what problem does this solve? I don't get a really good answer. And so if a client says, "Hey, interested in crypto. I want to own 2, 3, 4% of my liquid portfolio in it," I'm not going to stop them. Some of the crazies own 30, 40, 50%. That just seems kind of risky. But I like to point out to people this iPhone came out more or less in the same year as Satoshi's white paper. And when you think about the millions and millions and millions of problems this has solved and how the utility of this will tell me where to make a turn when I'm driving someplace I don't know. I could check my bank and brokerage balances. I set up my doctor's report. Oh, look, there's my x-ray for my hip replacement surgery. Like everything is on this. This solves problem after problem after problem after problem. And it's born the same year that crypto was born. In fact, crypto, if it was a person, can vote in every state in the nation and can drink in a number of them. And yet, I still don't know what problem it solved. There's theoretical smart contracts, and you could buy tickets on the blockchain, and there's all these different things I keep hearing about, but none of this seems to work its way into actual practice. And so if if Buffett is going to be wrong, the crypto enthusiasts have to come up with, there's the old joke about the guys in prison trading sardines, and one of the guys opens it up and eats it and says, these are terrible sardines. He goes, "What are you doing? Those aren't eating sardines. Those are trading sardines." And it's the same joke about crypto. Are they eating sardines? No, they seem to be trading sardines. So, as an entity that has a purpose that's sort of digital gold, an alternative to currencies, it's a good trading vehicle. But as of yet, it hasn't solved any problems, and I think we kind of are just stuck looking at it from askance. Let me know when it's as useful as software or AI or anything like that. But right now, crypto kind of feels like trading sardines to me
Although gold doesn't solve that many real, I mean, this value isn't based upon its industrial uses. It's a store of
anymore.
value.
Right. That's right. And by the way, one of the things that a chapter in the book that I got some really interesting pushback that nobody could really articulate intelligently is the dollar is not a store of value. I keep hearing people say, dollars lost 96% of its value over the past 100 years. Why would you hold a dollar for 100 years? It's a medium of exchange, not a store of value. You get paid in dollars. You go out and spend them, invest them, pay your taxes in them, give it away. That's the purpose of a dollar. It's not to sit with for 100 years or 10 years. And so whenever I hear that, oh, the dollar's lost 96% of its value, I don't know. If I would have put $1,000 into the market 100 years ago, and you put $1,000 in mason jars and bury it in the ground, yeah, technically you've lost 96% of your purchasing power. But 100 years later, that $1,000 in the market is worth $32 million. And so to me, that seems like a pretty good place to way to use dollars.
That's how you got $7 billion assets under management. That's
Right.
a I got to go get the mason jar. All right, how about AI? Are we in another tech bubble? I mean, I started my career in tech bubble 1.0. There is a ton, there's often it feels like fiber. We're like, boy, we're putting a lot of money into infrastructure. At the same time, the as with then, the evangelists often have me feeling like this time is different. What's your read on AI?
So no, this time it's exactly the same. But let me give you a little context that people might not be aware of. So, academic research from Joe Davis, who's the chief economist at Vanguard, looking at 100 years of technological innovations. Every innovation follows the same two-step pattern. Doesn't matter if it's railroads, telegrams, TV, automobiles, computers.com, AI, you name it, it's the same process. Phase one is sort of a land rush for all these companies that want to be the providers of these tools. Some people think of the Magnificent Seven as that. During the dot-com days, we know all the dot-coms and Metro Media Fiber and Juniper Networks and all those fun companies. The real value gets created in phase two, according to Davis, and I very much agree with him. What is phase two? Well, in the 90s, pets.com was an internet company and Yahoo was an internet company. Today, we're having this call with 130 people on Zoom. Every one of us has an email address, a website. We all use Slack and Teams. We all are digital and online. Every company is an internet company today, whether you like it or not. So when people talk about the Magnificent Seven, where the value creation is likely to take place after this big run up we've had in those seven companies is, call them the Magnificent 493. It's all the rest of the companies in the S&P 500 or in the Wilshire 5000 that are going to be using artificial intelligence to become more efficient, more productive, more profitable. What this means for employment, we really don't know. It looks like it's creating a headwind for people under 30. But you look at the under 30 unemployment rate is like 9.9% versus 4.3% for the broader public. It's more than double. It's almost 10%. And that's because a lot of people are using AI to replace the first years and the interns. That's going to create a problem down the road. You can't become a mid-level executive if you don't get training as a junior or a starting executive. But all that said, I think AI is going to just expand out the way internet did, the way computing did, the way mobile did. There was one telephone company 100 years ago. We all have telephones. It's not like there's one telephone company anymore. AI is going to be like that. There is since I mentioned the Magnificent Seven, let me give you a little caveat about that. One of the questions I get more than anything is, wow, 35% of the S&P, we've never had this much concentration in history. And that's not true, because go back to the railroads, they were 60% of the Dow, or just go back 100 years and AT&T, one company, was like 18% of the Dow. But hold that aside. When you look at the past 30 years of antitrust enforcement, I think it's generous to call it lax. We don't have the same sort of antitrust enforcement we used to. And we look at the seven biggest tech companies, the Magnificent Seven, they have done something like 893 acquisitions over the past 20 years. And some of these are sizable acquisitions that would be standalone. Apple bought Beats. It's a multi-billion-dollar audio company. Google bought YouTube. It's a giant video purveyor that on its own would probably be a $200 billion company. Slack was purchased by Salesforce. Teams was purchased as a small, like, you look at these companies, these big tech companies. Apple isn't a phone company. Microsoft isn't just Office. These are massive enterprises that offer such an array of services that they resemble the turn of the 19th century conglomerates more than the 1950s. These are 1890s, 1910 giant pre-Sherman Act companies that are just their tendrils are everything. And so, yeah, if you want to be technical, yeah, there's seven companies are 36%, 34% of the S&P 500. But if you drill down, they're really not seven companies. They're, hundreds of companies in 30 or 40 different areas. And if they were all freestanding independent companies, they'd probably be 30, 40, 50 S&P 500 companies. That's not hype as concentrated as some people think.
All right, last two questions. There's a lot about your work that I really like, not least you're a charts guy and you guys put out a lot of charts. And as you know, I like charts too. One of my very favorites, and you wrote about this once in your big picture thing, but you looked at the performance of the market over a long period of time under both Republicans and Democrats. And when all's said and done, the answer is up and to the right. Republican, Democrat, doesn't matter for investors, should they ultimately stop overthinking things, diversified, long term, low cost, try to minimize tax, and just don't let all of the, is there a problem with China? Are tariffs coming? What's the Fed fight going to mean? Is, BLS data going to be poisoned or not? Should people, and this, by the way, if the answer is yes, ignore Washington, it's bad for my business, but I'm asking you anyway, should people just, as a regular investor, ignore Washington?
So I'm going to phrase it in a different way. And I'm going to give you a little academic data on this. So first, if you just look at market performance when Democrats control the White House, a dollar turns into $87. If you just look at it when Republicans control the White House, it turns into $82. If you just look at it over the same time period going back to 1950, a dollar turns into $257. And so the lesson is job one is to prevent your big dumb lizard brain from interfering with the market's ability to compound over time. So that's one thing. I think it was either Yale or Dartmouth School of Business did a study and they anonymized the data and they looked at brokerage accounts based on zip codes. And when you're looking at things on zip codes, you can look and see how that zip code voted. And not surprisingly, when a zip code voted either very blue or very red and their guy lost, they moved out of stocks into cash for the next 6 months to 2 years. And of course, think about it. If you did that in 2009 when Obama won, you left a lot of money on the table. If you did that in 12, again, you left money on the table. If you did it in 16 when Trump won, you left a lot of money on the table. In 2020 with Biden, money on the table. And I heard from a bunch of people, oh, this Trump 2 is going to be a disaster. I want out. That was 12, 13% ago. And so it turns out presidents get more credit for when things go right and more blame when they get wrong. But the bottom line is we're a $29 trillion economy. Just getting up each day, feeding yourself, sending your kids to school, doing what you have to do. I don't know, that's 23, 24 trillion out of the 29 trillion. The president really has to screw up to affect that. So you want to look at Vietnam and Watergate. I've seen people make the arguments about Iraq and the financial crisis. I find it's really hard to blame any one person for any of those things. There's always a broad array of people, the old joke, success has a million fathers, but failure is an orphan. Yeah, all those failures had lots of people contributing, but the president is the one who always gets the finger pointed at them. And so the thought process is, don't let your partisan political views, usually driven by your parents' party affiliation and where you live, that's not significant to your portfolio allocation. You want to be invested for the long run. Democrats, Republicans, it doesn't matter. I have people telling me that, so we have a lot of clients on the coast and we have a lot of clients on the inner parts of the country. And I have people on the coast telling me, oh, this is it. This is the end of the stock market. And I have people in other cities saying our city has never been hotter. We've never been seeing more economic activity. I think there's a little bias on both sides. But I also think that there's a chart in the book. There's always a reason to sell. One goes back to 2009
Love
bottom.
that chart.
The other goes back 100 years. There's always something terrible going on in the world. And we exist in the here and now. We are very much wired to see metaphysical existential threats. If it bleeds, it leads, is what happens on the media. I'm pointing to my TV over there. social media, algorithmic social media makes all this much worse. And so sometimes I think you have to just be aware of how um, challenging it is to navigate all this noise. And you really just have to be selective. Ray Dalio famously said, every time you hear something is unprecedented, if you look at history, it turns out most people use the word unprecedented as not in my lifetime. So we had a global pandemic that shut the world economy. It wasn't unprecedented. We had one of those a century ago. We had this giant tariff situation that caused this lack of clarity and economic dust in the air. And it's all yeah, we had that in the 1930s. There really is nothing new under the sun. The expectation is this too shall pass.
The book is How Not to Invest. We bought 100 copies, and as we always do, we'll send a link around to those of you who actually showed up. When we run out of 100, Amazon will not run out, so you guys can go there. Barry, you've been generous with your time. It was great to actually, we've emailed so many times. It's great to actually connect live. That you brought Teddy Lamity is even better because boy, is his stuff good. And I'm glad you feature him too.
Well, my pleasure. Thanks so much for having me. And if you read the book, on the last chapter is an email address. Anyone has questions about the book, feel free to ask. I'm very happy to respond.
Thanks very much.
All right. Thanks, guys.